Today now we will start unit number 3, second part. In the previous part we have completed leverages. Now this part consists of capital structure. The second part of unit number 3. Capital structure. The long-term financing refers to the issue of equity, preference and debentures. There is a proper combination of the three which maximizes the value of equity shares, the value of the firm. Striking of such a balance is the conscious managerial effort by taking into account the cost and the valuation of the firm. So the long-term funds can be raised by the issue of financial instruments like equity shares, preference shares or debentures. The three should be in a proper combination. The three equity shares, preference shares should be in a certain proportion. The management has to consider a number of factors in order to make a proper combination of long-term funds which maximizes the market price of the share. A number of factors must be considered because every source of fund will have different cost. So by considering a number of factors, a proper combination of debt equity mix should be made. The proper combination, the combination of equity, preference and debenture is called capital structure. Combination of all long-term funds is called capital structure. So it is the responsibility of the finance manager to make a proper capital structure to maximize the market price of the share. Now we will start, there are two types of capitals like levered capital and unlevered capital. The preference shares and debentures have a fixed rate commitment, fixed rate of return commitment. Preference dividend should be paid at a specified fixed rate and interest has to be paid on debentures at a fixed rate. So these two combined are called levered capital. And those capital which does not carry any fixed commitment is called unlevered capital. So equity comes under unlevered capital, preference and debentures comes under levered capital. It is the responsibility of the finance manager to make a proper combination of all these three sources of funds. No company can depend only on one form of capital. Now in this unit, in this topic of capital structure, we are going to study what are the theories available of this capital structure, how the finance manager can take the decision of proper combination of debt and equity mix. Now we'll discuss about the factors to be considered in raising long-term finance. When a business is confronted with the problem of raising long-term finance, like equity or debentures or shares, equity shares, preference shares or debentures, a number of factors must be considered before raising the funds. What are the factors? First factor is volatility of earnings. Volatility of earnings. If the corporate earnings are volatile, fluctuate from year to year due to a number of factors like seasonality or anything. So when the corporate earnings are fluctuating, volatile, then the company must resort to more on equity, less on debt because the risk is more. The company does not know when the profits will come down. So always they will not take much risk. This company will apply more of equity than debt. Less debt and more equity because the company's earnings are volatile. If the company's earnings are stable, then the company can take the advantage of debt. But if the earnings are volatile, the company is suggested to more depend on equity rather than debt. Next comes business risk. Every business has inherent some type of risks due to economic and non-economic factors like political stability, then economic condition, economic factors, technological obsolescence or market competition. Number of factors are there. These factors will affect the business risk. So if a business is confronted with this type of risks, then again it is suggested to go for unlevered capital. The company should resort to more an equity rather than debt because already lot of risk is attached. If we put more debt, some more risk will apply. Next one is cost of capital. Every source of funds will have a cost. The company will not get the funds free of cost. For example, when the company issues equity shares, the company has to pay equity dividend. When the company issues preference shares, the company has to pay preference dividend. When the company issues debentures, the company has to pay interest. So cost is attached. KE stands for cost of equity, KP cost of preference, KD cost of debt. If we combine all these, we'll get KO, overall cost of capital. So while deciding from where to procure the long-term funds, the cost of capital must be considered. The company wants to raise the funds at the lowest cost. At the lowest cost. Next one is degree of diversification. If a company is engaged in multiple products, then its risk will be diversified. Normally, these type of companies which resort to diversification have a stable earnings. Because the company is producing and producing and distributing different products, the risk will be neutralized. In such a case, the company can take further risk, so the company can go for leveraged capital. So a company which has diversification, which has a high degree of diversification, the company can take further risk by issuing levered capital, by issuing debt. Tax loss. Another factor to be considered is tax loss. According to Income Tax Act, the interest paid on borrowed fund will be allowed as deduction while computing the taxable income. So if a company has raised the funds through debt, the actual cost of debt will come down on account of this tax benefit, tax shield. Because whatever interest paid on debentures or debt will be allowed as deduction in computing the taxable income. Whereas the return paid in the form of equity dividend or preference dividend are not allowed as deduction. So in that case, there is no tax shield in case of equity and preference dividend. So this fact, the tax laws should also be considered while raising the long-term funds. Next is determination of optimum capital structure. Determination of optimum capital structure. What is an optimal capital structure? A capital structure which maximizes the market price of share. A capital structure where the overall cost of capital will be the lowest. So in this case, the finance manager has to resort to evaluating different combination of debt equity mix in order to find out at which point of time the overall cost of capital will be lowest and the market price of share will get maximized. So optimal capital structure is that capital structure at which the overall cost of capital will reduce. So a new company will not have much debt because it does not have any credit worthiness. An old company which is already in existence for so many years, the people will come forward, the people have trust because their earnings are more. In that case, the investors will invest the money in debt also in an old company. But that too, an old existing company cannot resort to more and more debts, because when the company takes more and more debts, the marginal cost of debt will also increase, because no investor wants to invest in a company which already has so much of debt. So investors will not come forward to invest in that company which has more debt. So there is a limit on raising the debt. So company has to evaluate, is it beneficial to raise the long-term funds through debt or equity? So proper combination of debt equity mix is called optimal capital structure. No financial management literature will give a methodology how to find out the optimal capital structure. It is purely a judgment of the finance manager to evaluate from their company point of view what is the optimal capital structure. So there is no standard formula, there is no standard method to find out what is the optimum capital structure. तो एक कंपनी का कैपिटल स्ट्रक्चर अलग है, एक कंपनी का कैपिटल स्ट्रक्चर अलग है, डिपेंडिंग ऑन देयर रिक्वायरमेंट circumstances. So we cannot give any standard mix of debt equity. That is all about determination of optimal capital structure. Now, capital structure theories. In order to attain the goal of finding an optimum debt equity mix, the finance manager should be conversant with the number of theories of capital structure. Capital structure theories are there. Those theories, the finance manager must know those theories in order to attain the goal of finding out an optimal debt equity mix. The four theories are: first one, net income approach. Net income approach, or NI approach it is called. NI approach. According to this approach, there is a direct relationship between the capital structure and the market price of share, value of the firm. There is relationship between the capital structure, cost of capital, and the market value of the firm. So this theory states that if we change the capital structure, it will have the effect of changing the market value of the firm. It will affect the overall cost of capital. According to this theory, the cost of debt will be lower than the cost of equity. So a firm must employ more long-term debt to reduce the overall cost of capital. अगर फॉर एग्जाम्पल 10 लाख रुपीस टोटल कैपिटल एम्प्लॉयड है, उसमें 10 लाख रुपीस में 6 लाख रुपीस डेट एंड 4 लाख रुपीस इक्विटी है, तो इन दैट केस व्हाट विल हैपन, the overall cost of capital will be lower, because normally the cost of debt will be lower than the cost of equity. तो जितना ज्यादा डेट को रखेंगे उतना ओवरऑल कॉस्ट कम होगा, और ओवरऑल कॉस्ट कम होने से मार्केट प्राइस ऑफ शेयर ज्यादा होगा. तो ये नेट इनकम अप्रोच का कहना ये है, by changing the capital structure, it will affect the market price of share. There is relationship between capital structure and the market price of the share. This is according to NI approach. Second approach is net operating income approach. Net operating income approach, NOI. This approach is exactly opposite to NI approach. तो NI अप्रोच ये कह रहा है कि दोनों में रिलेशनशिप है, मार्केट इधर कैपिटल स्ट्रक्चर को चेंज करो, उधर मार्केट प्राइस चेंज होगा. ये कंटेंशन NI का है. NOI कह रहा है कि देयर इज नो रिलेशनशिप एट ऑल. Whatever change you make in debt equity mix, it will not affect the overall cost of capital. It will not affect the overall cost of capital. It will not affect the market price of the share. कोई फर्क नहीं पड़ता, कैपिटल स्ट्रक्चर चेंज करो, डेट इक्विटी मिक्स को चेंज करो, मार्केट प्राइस ऑफ शेयर उतना ही रहेगा. ये कंटेंशन है नेट ऑपरेटिंग इनकम अप्रोच का. ये कंटेंशन इसलिए है कि जैसा जैसा डेट कंटेंट बढ़ता जाएगा, बिजनेस में डेट कंटेंट बढ़ता जाएगा, द एक्सपेक्टेशन ऑफ इक्विटी शेयर होल्डर्स विल ऑल्सो इंक्रीज. नो इक्विटी शेयर होल्डर विल बी रेडी टू इन्वेस्ट इन अ कंपनी विच इज ऑलरेडी हैविंग सो मच ऑफ रिस्क. अगर रिस्क ज्यादा है तो एक्सपेक्टेशन ऑफ इक्विटी शेयर होल्डर विल इंक्रीज. तो बेनिफिट जो मिल रहा है डेट से वो नलिफाई हो जाएगा बाय इंक्रीज इन द कॉस्ट ऑफ इक्विटी. सो ओवरऑल कॉस्ट ऑफ कैपिटल विल रिमेन सेम. देयर इज नो ऑप्टिमल डेट इक्विटी मिक्स अकॉर्डिंग टू नेट ऑपरेटिंग इनकम अप्रोच. नाउ Modigliani and Miller approach. The third approach is MM approach. Modigliani and Miller approach. This Modigliani and Miller have supported the NOI theory. They says there is no relationship between capital structure and the market value of the firm. Whatever be the change in capital structure, it will not give any effect to the market value of the firm. It will remain same. It will not affect the overall cost of capital. Overall cost of capital will remain same even if you change this debt equity mix. But Modigliani and Miller has given some assumptions of this theory. On the basis of those assumptions only, they says that there is no relationship. The assumptions are the capital markets are perfect. There is no inefficiency involved in the capital market. Capital markets are perfect. Secondly, assumption is the investors are rational in their behavior. The investors are rational. Third one is the information is freely available to everybody in the market. Market में सबको information है. The lenders and the borrowers have complete information about the market. Next one is there are no transaction cost. and securities are completely substitutable. There are no taxes. There are no taxes at all. On the basis of all these assumptions, Modigliani and Miller says there is no relationship. But unfortunately, these assumptions, whatever Modigliani and Miller has given, that is impractical. That is not practical at all. That's only theoretical. Because in reality, the markets are not perfect. Some inefficiency will be there. Similarly, all the investors are not rational. Many investors will behave irrationally. Transaction costs are there, taxes are there. So all these factors are present. Whereas Modigliani and Miller says, on the basis of this assumption, they have given theory. Now, traditional approach. Traditional approach is the last approach of capital structure theories. It's a combination of NI approach and NOI approach. So traditional approach ये कह रहा है, to some extent NI approach is correct. What NI approach is correct? That means as we increase the debt content in the capital structure, the overall cost of capital will come down and the market value of the share will increase. To some extent, जैसा जैसा थोड़ा डोज डेट का डालते जाएंगे, डेट थोड़ा इंक्रीज करते जाएंगे, so due to financial leverage, the financial leverage will cause the market price of share to increase. But this will not be up to any limit. Up to a certain limit, this effect will be there. After that, what will happen? NOI approach will be applicable. NOI approach says, even if you change the debt equity mix, the market price of share will remain same. तो जैसा जैसा डेट कंटेंट बढ़ते जाएंगे, तो स्टार्टिंग में कुछ लिमिट तक क्या होगा, ये डेट कंटेंट लीवरेज का काम करके ईपीएस को बढ़ाएगा, मार्केट प्राइस ऑफ शेयर बढ़ेगा. लेकिन जैसा जैसा डेट और इंक्रीज करते जाएंगे, रिस्क बढ़ता जाएगा. जब रिस्क बढ़ता जाएगा तो मार्जिनल कॉस्ट ऑफ कैपिटल भी इंक्रीज होगा एंड एक्सपेक्टेशन ऑफ इक्विटी शेयर होल्डर्स भी इंक्रीज होगा. जब एक्सपेक्टेशन ऑफ इक्विटी शेयर इंक्रीज हो रहा, मार्जिनल कॉस्ट ऑफ डेट इंक्रीज हो रहा, तो वट एवर बेनिफिट वी गॉट ऑफ लीवरेज, दैट विल बी नलिफाइड. सो NOI अप्रोच विल बी एप्लीकेबल. To some extent NOI approach, later on NOI approach, that is according to traditional approach. So these are the theories which must be understood by the finance manager. He should keep in mind while making the proper debt equity mix. Now next topic is EBIT EPS analysis. This EBIT EPS analysis is very important in deciding from where to procure the funds. When a company wants new funds, the new funds should be procured from which source? Should it be raised through equity or preference or debentures? तो ये डिसीजन लेने के लिए कि नया फंड हमको कहां से रेज करना है, ये डिसीजन लेने के लिए हमको एक एनालिसिस कहते हैं कॉल्ड EBIT EPS एनालिसिस. तो इसमें क्या होता है, we will find out what is the effect of raising these funds on EPS. अगर हम ये पैसा जो रेज करें, इक्विटी से रेज करें तो EPS पे क्या इफेक्ट है, प्रेफरेंस से रेज करेंगे तो क्या इफेक्ट है, और डिबेंचर से रेज करेंगे तो क्या इफेक्ट है, या विल मेक द combination of debt and equity, 50% equity 50% debentures अगर रेज करें तो what will the effect of an equity, और 50% equity and 50% preference से रेज करें तो what is the effect on EPS. Similarly, if we raise the funds through all the three, equity, preference, debenture, what will be the effect on EPS. So under different levels of EBIT, we are going to find out what is the effect on EPS. This is called EBIT EPS analysis. And this EBIT EPS analysis will be helpful in deciding from where to procure the new funds. Next point is indifference point. Indifference point is that level of EBIT at which two different financial plans will give the same EPS. दो फाइनेंशियल प्लान्स का EPS सेम होगा, तो कितने EBIT लेवल के ऊपर दोनों प्लान का EPS सेम होगा, वो EBIT लेवल को कहते हैं इंडिफरेंस पॉइंट. दैट लेवल इज कॉल्ड इंडिफरेंस पॉइंट. सो इन सिंपल वर्ड्स, इट इज दैट EBIT, indifference point is that EBIT at which two plans will give the same EPS. हाँ, अगर इंडिफरेंस पॉइंट से ज्यादा अगर EBIT अगर हो गया, that means levered capital will be beneficial. Simple example I'll give you. Suppose 3 lakh rupees EBIT is the indifference point. अगर हमको इंडिफरेंस पॉइंट 3 लाख रुपीस आ गया, तो इसका मतलब हो गया 3 लाख रुपीस इंडिफरेंस पॉइंट के ऊपर दो फाइनेंशियल प्लान्स का EPS सेम होगा। अगर हमारा एक्चुअल EBIT 3 लाख से ज्यादा होगा तो वी प्रेफर लीवर्ड कैपिटल। लीवर्ड कैपिटल को हम प्रेफरेंस देंगे अगर एक्चुअल EBIT हैपेंस टू बी मोर देन इंडिफरेंस पॉइंट। अगर एक्चुअल EBIT हैपेंस टू बी लेस देन इंडिफरेंस पॉइंट, वी प्रेफर अनलीवर्ड कैपिटल, इक्विटी कैपिटल। तो 3 लाख से कम होने के चांसेस है तो अनलीवर्ड, 3 लाख से ज्यादा चांसेस है तो लीवर्ड, एग्जैक्टली 3 है तो इनडिफरेंट। इनडिफरेंट का मतलब कोई कहीं से भी रेज करो, चाहे इक्विटी से रेज करो या डिबेंचर्स से रेज करो, कोई फर्क नहीं पड़ेगा। इसको कहते हैं इंडिफरेंस पॉइंट। तो हाउ टू फाइंड आउट द इंडिफरेंस पॉइंट? वी हैव टू मेथड्स। द फर्स्ट मेथड ऑफ फाइंडिंग आउट द इंडिफरेंस पॉइंट इज ट्रायल एंड एरर मेथड। रफली टेक एन EBIT, अंदाजे के तौर पे एक EBIT 5 लाख रुपए ले लिए, लेकर दोनों प्लान्स का EPS मालूम करेंगे। अगर दोनों प्लान का EPS बराबर आ गया तो 5 लाख रुपए हम जो EBIT लिए थे वो इंडिफरेंस पॉइंट हो गया। अगर फॉर एग्जांपल नहीं हुआ, EPS अलग अलग है, तो फिर वी हैव टू चेंज द EBIT। अब EBIT पहले 5 लाख रुपए लिए थे, अब 4 लाख रुपए EBIT लेंगे, लेकर फिर मालूम करेंगे EPS कितना है। अब EPS दोनों का सेम नहीं आ रहा, फिर चेंज करेंगे, 6 लाख रुपीस लेंगे। इस तरह ट्रायल एंड एरर, ए नंबर ऑफ EBIT we take and check whether we are getting same EPS or not. But this method is not recommended because it will take lot of time. Time consuming method. एक रेट लेते जाना, चेक करते जाना, नहीं आ रहा फिर चेंज करना, फिर चेंज करना, so many times you have to change. So what is the alternative? Mathematical method is there. Mathematical formula is there to find out the indifference point. Without checking, directly we can get the indifference point. अब ये मैथमेटिकल फॉर्मूले के लिए फर्स्ट, अगर इन वन प्लान वी हैव ओनली इक्विटी एंड द अदर प्लान वी हैव इक्विटी एंड डिबेंचर्स। एग्जांपल, कंपनी को 10 लाख रुपए चाहिए, कंपनी के सामने दो ऑप्शंस है, पूरे 10 लाख रुपए इक्विटी से रेज करेंगे या 10 लाख रुपए में से 5 लाख रुपए इक्विटी और 5 लाख रुपए डिबेंचर्स। तो हम कहेंगे इन वन प्लान वी हैव ओनली इक्विटी, सेकंड प्लान वी हैव इक्विटी एंड डिबेंचर्स। तो अगर ऐसा सिचुएशन है तो ये फॉर्मूला अप्लाई करेंगे। व्हाट इज दैट फॉर्मूला? x into 1 minus t divided by n1 is equal to x minus I into 1 minus t divided by n2। ये फॉर्मूला डालने से हमको इंडिफरेंस पॉइंट आ जाएगा। तो इसमें अब्रिविएशन x का मतलब यहां पर दिया हुआ है, x is the EBIT at indifference point। x stands for EBIT at indifference point। ये अननोन है, ये मालूम करना है हमको। T stands for tax rate, प्रॉब्लम में दे देगा, and I stands for interest on debentures, and N1 stands for number of equity shares if only equity shares are issued। अगर कोई प्लान में खाली इक्विटी शेयर इश्यू कर रहे हैं तो कितने इक्विटी शेयर इश्यू करेंगे, वो N1, and N2 stands for number of equity shares outstanding if equity share and debentures both are issued। अगर कोई प्लान में इक्विटी और डिबेंचर्स दोनों भी इश्यू कर रहे हैं तो फिर वो कितने इक्विटी शेयर्स है उसको N2 ट्रीट करें। तो ये फॉर्मूला x into 1 minus t by n1 is equal to x minus I into 1 minus t divided by n2। ये फॉर्मूला कब मालूम करेंगे? when we are finding out the indifference point in which we have one plan we have only equity, second plan we have equity and debentures। second, equity versus equity plus preference। एक प्लान में ओनली इक्विटी है और दूसरे प्लान में इक्विटी एंड प्रेफरेंस। तो ऐसा सिचुएशन में फॉर्मूला x into 1 minus t by n1 is equal to x into 1 minus t minus p divided by n3। तो ये जो फॉर्मूला है ये इक्विटी प्लस प्रेफरेंस का है और ये फॉर्मूला ओनली इक्विटी का, ओनली इक्विटी। हियर x stands for EBIT at indifference point, ये मालूम करना है, T tax rate, N1 number of equity share if only equity share are issued। X मालूम करना है, T tax rate है, P stands for preference dividend, P stands for preference dividend, N3 stands for number of equity shares outstanding if equity share and preference share are issued। अगर कोई प्लान में इक्विटी शेयर और प्रेफरेंस शेयर दोनों भी इश्यू कर रहे हैं तो कितने इक्विटी शेयर्स हैं उसको N3 कहेंगे। अब लास्ट इक्विटी वर्सेस इक्विटी प्लस प्रेफरेंस प्लस डिबेंचर, यानी एक प्लान में ओनली इक्विटी है और दूसरे प्लान में इक्विटी प्रेफरेंस डिबेंचर तीनों भी। तो ऐसे सिचुएशन में द फॉर्मूला इज x into 1 minus t by n1 is equal to x minus I into 1 minus t minus p divided by n4, divided by n4. Again here I stands for interest on debentures, P stands for preference dividend, and N4 stands for number of equity shares outstanding if equity share, preference share and debentures are issued. पूरे मिला के इश्यू करें तो कितने इक्विटी शेयर इश्यू करें, इसके पूरे अब्रिविएशंस मीनिंग यहां पर दे दिया सिंबल्स में। N1 number of shares outstanding if only equity shares are issued, N2 number of equity share outstanding if equity share and debentures are issued, N3 number of equity share outstanding if equity share and preference shares are issued, N4 number of equity share outstanding if equity share, preference share and debentures are issued. T stands for tax rate, I stands for interest on debenture, P stands for preference dividend, and X stands for EBIT at indifference point. That's all. This is the complete theory regarding capital structure. Briefly, in 5 minutes, we'll recap the points. Then, in the next session, we'll start the problems on capital structure. Right? In financing decisions, in unit number 3, we have 3 topics. The first topic, leverage. Second, capital structure. Third, cost of capital. The first one, leverage, we have completed in the previous session. Now, capital structure. Capital structure is the combination of long-term funds. The long-term finance can be raised either by equity or by preference or by debenture. There is a proper combination of all these three which maximizes the market price of share. So it is the responsibility of the finance manager to find out how to make a proper combination of these three which maximizes the market price of share. So this chapter, capital structure, will help, this tool will help the finance manager in achieving his objective of making proper debt equity mix. So 2 types of capital will divide, levered, unlevered. Levered का मतलब है उसके अंदर जहाँ डेट है, जो कैपिटल में डेट मिला हुआ रहेगा वो लीवर्ड है, और जो कैपिटल में डेट मिला हुआ नहीं है वो अनलीवर्ड है। डेट का मतलब खर्चा जिसके ऊपर फिक्स्ड रेट ऑफ इंटरेस्ट, जहां पर फिक्स्ड रेट ऑफ इंटरेस्ट पे करेंगे वो डेट कैपिटल लीवर्ड है, जहां पर फिक्स्ड रेट ऑफ रिटर्न नहीं पे करना है वो इक्विटी है, राइट? तो व्हाट आर द फैक्टर्स? A number of factors must be considered while raising the long-term funds. Volatility of earnings है, business risk है, cost of capital, degree of diversification, tax laws. Briefly, these are the items which must be considered while deciding from where to procure the funds. Determination of optimal capital structure. It's not an easy task. It depends on the judgment of the finance manager how to make an optimum capital structure. An optimum capital structure is that capital structure which maximizes the wealth of shareholders, maximizes the market price of share. तो ऐसा कैपिटल स्ट्रक्चर बनाना जिससे ओवरऑल कॉस्ट ऑफ कैपिटल कम होना और मार्केट प्राइस ऑफ शेयर बढ़ना. तो इट रिक्वायर्स लॉट ऑफ जजमेंट ऑफ द फाइनेंस मैनेजर. देयर इज नो स्टैंडर्ड फॉर्मूला, कोई स्टैंडर्ड मेथड, कोई स्टैंडर्ड फॉर्मूला नहीं है कि ये इस तरह का हम स्टैंडर्ड कर सकते. ए नंबर ऑफ फैक्टर्स मस्ट बी कंसिडर्ड. सब फैक्टर्स को कंसिडर करके एक प्रॉपर कॉम्बिनेशन बनाना बिटवीन डेट एंड इक्विटी, दैट इज ऑप्टिमम डेट इक्विटी. कैपिटल स्ट्रक्चर थ्योरीज में a number of theories have been given by different authors regarding the relationship between the capital structure, cost of capital and the market value of the firm. ये 3 चीजों में जो रिलेशनशिप बता रहा उसको कैपिटल स्ट्रक्चर थ्योरीज कहते हैं. तो कैपिटल स्ट्रक्चर थ्योरीज 4 है: NI approach, NOI approach, Modigliani and Miller approach, and lastly traditional approach. NI approach, there is relationship between capital structure and market price. यहाँ पर capital structure change करो, वहाँ पर market price change होगा. Capital structure में debt content को ज्यादा कर दो, overall cost कम होगा, market price बढ़ेगा. ये कौन कर रहा है? NI. NOI कह रहा है कि no relationship at all, कुछ भी change कर लो कोई फर्क नहीं होता. डेट को कम रखो, डेट को ज्यादा रखो, कोई फर्क नहीं पड़ता, ओवरऑल कॉस्ट ऑफ कैपिटल उतना ही रहेगा, मार्केट प्राइस ऑफ शेयर पे कोई इफेक्ट नहीं होता. ये लोग के अपने assumption बेसिस के ऊपर एनओआई अप्रोच. और एनओआई अप्रोच का मेन सपोर्टर जो है वो मॉडिग्लियानी एंड मिलर है. तो मॉडिग्लियानी एंड मिलर सेज there is no relationship between capital structure and market price.